Beginning in the 1990s, deregulation and advances in technology led to an explosion of complex financial products called derivatives. Economists and bankers claimed they made markets safer, but instead, they made them unstable. Using derivatives, bankers could gamble on virtually anything. They could bet on the rise or fall of oil prices, the bankruptcy of a company, even the weather. By the late 1990s, derivatives were a $50 trillion unregulated market.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
In 2000, Senator Phil Gramm took a major role in getting a bill passed that pretty much exempted derivatives from regulation.
They are unifying markets, they're reducing regulatory burden. I believe that we need to do it.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives.
Once that was done, it was off to the races. And the use of derivatives and financial innovation exploded dramatically after 2000.
So help me God.
So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world.
30 years ago, if you went to get a loan for a home, the person lending you the money expected you to pay him or her back. You got a loan from a lender who wanted you to pay him back. We've since developed securitization, whereby the people who make the loan are no longer at risk if there's a failure to repay.
In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called Collateralized Debt Obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong. Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled. In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings. Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.
All the incentives that the financial institutions offered to their mortgage brokers were based on selling the most profitable products, which were predatory loans.
If the banker makes more money if they put you in a subprime loan, that's where they're gonna put you.
From 1996 until 2006, real home prices effectively doubled.
At $500 a ticket, they've come to hear how to buy their very own piece of the American dream.
You don't have to have a lousy home
The low-income home buyer can have just as nice a house as anybody else.
Goldman Sachs, Bear Stearns, Lehman Brothers, Merrill Lynch were all in on this. The subprime lending alone increased from $30 billion a year in funding to over $600 billion a year in 10 years. They knew what was happening.
On Wall Street, annual cash bonuses spiked. Traders and CEOs became enormously wealthy during the bubble. Lehman Brothers was a top underwriter of subprime lending, and their CEO, Richard Fuld, took home $485 million.
He proceeded to deliver this fearsome attack on short sellers, the people who were depressing Lehman's share price by being short the stock. Rather to everyone's surprise and mystification, he said,
"If we get this right today, hope it will squeeze some of those shorts. Not that I want to hurt them. Don't get that, please, because that's just not who I am. But what I really want to do is I want to reach in, rip out their heart, and eat it before they die."
I think in the tape there's a sort of nervous laughter in the auditorium. I think that sort of reflects quite a lot about how people within Lehman saw Dick. On the one hand, it sounded at one level amusing, and then you sort of thought to yourself, I suspect if you're in that audience, the really scary thing is he sort of could probably do it.
It wasn't real profits, it wasn't real income, it was just money that was being created by the system and booked as income 2-3 years down the road. There's a default, it's all wiped out. I think it was, in fact, in retrospect, a great big national, and not just national, global Ponzi scheme.
Through the Home Ownership and Equity Protection Act, the Federal Reserve Board had broad authority to regulate the mortgage industry. But Fed Chairman Alan Greenspan refused to use it.
Alan Greenspan said, no, that's regulation. Ideologically, I don't believe in it.
For 20 years, Robert Gnizda was the head of Greenlining, a powerful consumer advocacy group. He met with Greenspan on a regular basis.
We gave him an example of countrywide and 150 different complex adjustable rate mortgages. He said, if you had a doctorate in math, you wouldn't be able to understand them enough to know which was good for you and which wasn't. So we thought he was going to take action.
In this amazing world of instant global communications, the free and efficient movement of capital is helping to create the greatest prosperity in human history.
146 people were cut from the enforcement division of the SEC. Is that what you also testified to?
Yes. Yeah, I think there has been a systematic gutting, or whatever you want to call it, of the agency and its capability through cutting back a staff.
The SEC Office of Risk Management was reduced to a staff, did you say, of one?
Yeah, when that gentleman would go home at night, he could turn the lights out.
During the bubble, the investment banks were borrowing heavily to buy more loans and create more CDOs. The ratio between borrowed money and the bank's own money was called leverage. The more the banks borrowed, the higher their leverage. In 2004, Henry Paulson, the CEO of Goldman Sachs, helped lobby the Securities and Exchange Commission to relax limits on leverage, allowing the banks to sharply increase their borrowing.
The degree of leverage in the financial system became absolutely frightening. Investment banks leveraging up to the level of 33 to 1, which means that a tiny 3% decrease in the value of their asset base would leave them insolvent.
When you begin to do the arithmetic of what the rising debt level implied by the deficits tells you, and add interest costs to that ever-rising debt at ever higher interest rates, the system becomes fiscally destabilizing.